Hey guys, welcome back to the channel. So, taxes are not too far away, and in order to prepare for tax season, I want to go over some things that, help maybe like some strategies to help you protect like your income taxes and stuff like that. If these are some of these things you're doing now, maybe some of these things you're not doing currently, but maybe you might think about doing, right? Because, income tax, right? Income is going to be taxed at the federal, state, and local levels, right? And earned income is subject to additional levies, right? To fund, things like Social Security, Medicare, some other stuff, right? So taxes are difficult to avoid, but there's some strategies to help ward them off, right? And I kind of want to go over, just a handful, like five or six. The first one that I want to talk about, it's going to be, invest in, mutual bonds, right? Municipal bonds. So, buying a municipal bond essentially means lending money to a state or local government entity for a set number of interest payments over a predetermined period, right? And once the bond reaches its maturity date, the full amount of the original investment is repaid to the buyer. So, interest on municipal bonds is exempt from federal taxes and may be tax exempt at the state and local level as well, depending on where you live. Some tax free interest payments make municipal bonds attractive to some investors. Now, municipal bonds historically have lower default rates than their corporate bond counterparts, but a study of municipal bonds from 1970 to 2019 found that the default rate was 0.1% for investment grade municipal bonds versus 2.25% for global corporate issuers. However, municipals typically pay lower interest rates, right? Because of the tax benefits, municipal bonds' tax equivalent yield makes them attractive to some investors, right? The higher your tax bracket, the higher your tax equivalent yield, right? So the next thing we're going to move into is going to be capital gains, right? You should shoot for long-term capital gains, right? Short-term capital gains are not so good, right? Because investing can be an important tool in growing your wealth, right? We want to have more wealth, right? An additional benefit from investing in stocks and mutual funds and bonds and real estate, it's going to be that favorable tax treatment for long-term capital gains, right? So, an investor holding a capital asset for longer than 1 year, you're going to enjoy that preferential tax rate of 0%, 15%, or 20% on the capital gain, right? And that's we talked about this in the previous video. It really that's going to depend on your income level, right? If the asset is held for less than a year, before selling it, well, that capital gain is going to be taxed at ordinary income rates, right? And you really got to understand the long term versus short term capital gains rates because it's really important for when you're trying to grow your wealth, right? So let's say for 2020, right, a married couple filing jointly would pay 0% on their long term capital gains if their taxable income falls below 80,000 and in the case of a single individual below 40,000, right? So for 2021 though, the zero rate bracket for long-term capital gains applies to taxable income up to 80,000 for married couples. It's 80,800 and then 40,400 for single, right? Slightly above where it was in 2020, but not much to make a huge difference. A tax planner and investment advisor can help determine when and how to sell appreciated or depreciated securities. That way they can minimize gains and maximize losses, right? And if you're doing investing and stuff, you might have heard this term called tax loss harvesting, right? That's kind of what that's talking about. Because with tax loss harvesting, right, it's going to offset, capital gains tax liability by selling securities at a loss, right? So if capital losses exceed capital gains, the lesser of 3,000 of the excess losses or the net capital loss can be deducted from other income. And capital losses in excess of 3,000 can be carried forward to later tax years, right? So the next thing I want to talk about, which is really big in today's world, right? The entrepreneur economy is what I like to call it. Talk about starting a business, right? Because in addition to creating more income, right, a side business offers a lot of tax advantages. When used in the course of daily business, many expenses can be deducted from income. It's going to reduce that total tax obligation, right? Especially important tax deductions for self-employed individuals are, let's say, health insurance premiums, which are available if some special requirements are made, right? Um, if you strictly follow the IRS guidelines, a business owner may deduct part of their home expenses with the home office deduction. The portion of utilities and internet used in the business may also be deducted from income. In order to claim these deductions, the taxpayer must conduct business to make a profit. The IRS evaluates a number of factors outlined in publication 535. I had to look that up because I wasn't sure. Taxpayers who realize a profit in 3 of the last 5 years are presumed to be engaged in a business for profit. The setting every community up for retirement enhancement, or the Secure Act, was enacted in 2019, right? And this act offers tax incentives to employers who join multiple employer plans and offer retirement options to their employees, right? Speaking of, that's what I want to talk about next is your retirement accounts, right? And employee benefits, right? Maxing these out. Because in both 2020 and 2021, taxable income can be reduced for contributions up to $19,500 to a 401k or a 403b plan, right? And for people who are 50 or older, you can add $6,500 to the basic workplace retirement plan contribution. So, for example, an employee earning $100,000 in 2020 or 2021 who contributes $19,500 to a 401k reduces taxable income to only $80,500, right? Not bad. So those who don't have a retirement plan at work can get a tax break by contributing up to $6,000, or if you're 50 or older, $7,000 to a traditional individual retirement account, an IRA, for 2020 and 2021. Taxpayers who do have workplace retirement plans, or spouses who do, may be able to deduct some or all of their traditional IRA contribution from taxable income, depending on your income, of course. The deduction is phased out for adjusted gross incomes at different levels. It's higher in 2021 than in 2020, depending on whether claimed on a single taxpayer's return, joint return, married individual filing separately, as well as taking into account any participation by a taxpayer in another plan. The IRS has detailed rules about whether and how much you can deduct, right? I also kind of want to talk about fringe benefits, because in addition to retirement plan contributions, many employers offer a variety of fringe plans that allow employees to exclude the contributions made or benefits received from their income. Benefits under these programs generally are reflected as non-taxed amounts on employees' W-2 statements. These benefits include flexible spending accounts, educational assistance programs, adoption expense reimbursements, transportation cost reimbursements, group term life insurance up to $50,000, and generally for senior managers and executives, deferred compensation arrangements, right? So the next one I want to talk about is something I feel like doesn't get enough attention. It's HSAs, right? A health savings account. Employees with a high deductible health insurance plan can get an HSA to reduce taxes. As with a 401k, HSA contributions, which may be matched by the employer, sometimes they are, sometimes they're not, by payroll deduction, are excluded from the employee's taxable income. An individual's direct contributions to an HSA are 100% tax deductible from their income. So for 2021, the maximum deductible contribution level is $3,600 for an individual and $7,200 for a family. In 2022, those maximums are going to go up, $50 for the minimum for single, right? So $3,650 for individuals, $7,300 for families, right? These funds can then grow without the requirement to pay tax on the earnings. An extra tax benefit of an HSA is that, when used to pay for qualified medical expenses, withdrawals aren't taxed either, right? So, one of the last things I want to talk about, which a lot of people, they overlook when doing their taxes, which is why I always say, get someone to do your taxes for you if you can, and I promise it's worth it, right? Claiming your tax credits, right? There's so many IRS tax credits that reduce your taxes, right? For 2021, a low income taxpayer could claim credits of up to almost $7,000 with three or more qualifying children, right? About 6 grand for two, and about 3,600 with one, right? And about $600 if none. The American Opportunity Tax Credit, it offers a maximum of 2,500 per year for eligible students for the first 4 years of higher education. And the lifetime learning credit allows a maximum of 20% credit, or up to 10,000 of qualified expenses, or 2,000 per return. There's also the savers credit for moderate and low income individuals looking to save for retirement. Individuals can receive a credit of up to half of their contributions to a plan, an IRA, or an ABLE account. The child and dependent care credit can, depending on your income, help offset qualified expenses for the care of children and, disabled dependents, right? I mean, there's so many different credits you can do, right? And, there's so many more, that's why it's really worth it for, if you can afford it, to have someone do your taxes and really go in there and like look for everything you can get, right? So what's the bottom line? What does this all mean? Well, although it's important to pay all that is legally owed to tax authorities, you shouldn't have to pay extra, right? A few hours on the IRS website, maybe going through some, really good financial information sites may yield a couple hundred or maybe even a couple $1,000s in savings. Like I said, people who do taxes for a living are really going to be able to get you the most out of it, right? So I would recommend, if you do the research yourself and look for what you can do, and otherwise, if you don't want to do the research, you don't want to get into it, stuff like that, get someone to do it for you, right? I really hope you guys enjoyed this video. If you're not subscribed to the channel, I'd really appreciate if you did. If you liked the video, go ahead and, hit that thumbs up button and share this video with some of your friends if you don't mind. Until I see you guys in the next video, y'all be safe.